Greetings, fellow investors. I'm Matthew Cochran, a lead advisor at Seven Investing, where it is our mission to empower you to invest in your future. We do that by providing monthly stock recommendations to our premium members and educational content that is freely available to everyone. Listeners, today I am very excited to introduce Kyler Hasson, who acts as a portfolio manager for Delta Investment Management. He can be found with his occasional blog post at concentratedcompounding.com and on Twitter, where I find his takes both entertaining and thoughtful. More specific to today's show, he's an investor in Berkshire Hathaway, the American multinational conglomerate holding company famously helmed by Mr. Warren Buffett. Warren Buffett, as basically everyone knows, is probably like the GOAT of investing, the greatest of all time. His track record is almost unparalleled. I personally find Berkshire Hathaway fascinating, though we don't talk about it too much at Seven Investing, where we often focus on more growthier type companies. If you're a listener of the show, you're probably familiar with the company, though. But if you're not, Berkshire owns everything from insurance companies and railroads to utilities and candy companies. And oh yeah, it's also one of the largest shareholders of like several large banks, Coca-Cola and Apple. So let's get to it. Kyler, welcome to the show.
Thanks for having me on.
Of course. So many investors discovered investing through the sage wisdom found in Buffett's letters. And because of that, they grow up as value investors. So I'm just curious if this includes you. Like, basically, how long have you owned shares in Berkshire? And how did you first discover Buffett?
Yeah, I actually got interested in investing probably my senior year in high school. We were playing a kind of a stock picking game, and I started to want to look at stocks, after that, and kind of understand why they're moving. And so I had a sort of friend of my father's who recommended some reading material, and I think it was Intelligent Investor, maybe Random Walk Down Wall Street. And so I started to read some of these books and get familiar. And then I think a first really natural place to go after that was to read Buffett's letters. This was 2008, roughly. He was already, the most famous investor in the world. And, so I went on Berkshire's website and started going through the letters, oldest to newest. And I would say that was probably the biggest source of information for me as a new investor, like it is for many other people. So that's where I kind of got my start with that sort of kind of quality investing that he does.
Sure.
Professionally, how long have I owned it? We've owned it since about 2013. Was our initial purchase, new clients, new money, and we've added from time to time since then. But yeah, it's been about seven and a half years now. And it's been a pretty good result.
Sure. Absolutely. So I briefly mentioned like everything it owned, and it's such a wide variety of companies and holdings. How should investors think of Berkshire? Like, is it more Geico, which it owns, or is it more Apple, which I think it's the largest, stakeholder in Apple?
Yeah. I really do think of it as a conglomerate. There's some major pieces and some things that are fairly big on their own, but don't really matter, just given how big Berkshire is. You could say Berkshire might be worth, call it $500 to $600 billion. The Apple stake is, well, depends on the exact price, but 100 billion, a little more. They've got a railroad that's worth, maybe about 100 billion, could be a little more. The insurance is similarly big. And then they have some smaller divisions that are still quite big by themselves. But, I really think of, unless he sells it at some point, I think of Apple as sort of just as important as the railroad, given their similar values. So I think of it as a collection of generally high quality businesses, financed in a quite conservative manner, little debt. Some of the insurance liabilities that they have are generally matched to treasury bills. So I think for me, it's a large company with many parts, with the common theme sort of being that conservative structure and the intelligent capital allocation.
Sure. So how do you begin to value this company? Do you have to add up all the different pieces to come to a smart valuation? Are there shortcuts? Do you look at price to earnings or price to book? Like, how do you approach valuing a company like this?
Yeah, that's a good and very interesting question that I thought about a lot. I've got a sort of a big spreadsheet. I'm not one for big complex models, but I have a big spreadsheet and I do a sum of the parts. I take every single business unit, I say what I think it's worth, and I add it all up. I don't think there's not tremendous complexity inside Berkshire. There are a lot of parts, but if you know, the 10K is going to come out pretty soon, I think. And if you just sort of slowly go through it and read it all, you can get a handle for every business that Berkshire owns, or rather, the big businesses and the big groups. They group some of them towards the bottom, but you can kind of get a handle on the whole thing. That's how I do it. What's funny is, you know, I have some friends that own it, and you know, one of them just kind of looks at price to book, doesn't do all the math, and we pretty much think it's cheap at the exact same times. And
Sure.
if you're on Twitter as well, I always find it really fascinating. It's like all of Twitter knows, no matter how they value it, they all know when Berkshire's cheap and when it's not. It's just sort of a, you know, I look at my model that I've spent all this time on,
Right.
and you know, there'll be certain times when I say, oh man, I think this is really cheap and looks really interesting. And, you know, all of FinTwit is like, oh wow, Berkshire looks really interesting right now. And they're mostly just using price to book. So,
Yeah, I think
uh,
that's what I do. Like, I would just, when you say that, after you're looking at your really nice fancy model, I'll go to Morningstar for 5 seconds and look at the price to book and be like, oh yeah, 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 you're right. I agree.
yeah,
Yeah,
yeah. And you know, I think for me, you know, now that I have the model, the upkeep's not too difficult. Just to update the parts when they move. But I think one thing for me is I want to understand, well, you know, might what I think is a good value on a price to book basis change over time? And I think the only way to really see that is to do all the underlying work. And so who knows, maybe Berkshire's sort of fair value on a price to book basis could stay pretty constant over time, and there would be some maybe complex underlying reasons for that. But maybe not. And I just want to make sure, you know, hey, in 3 or 4 years, maybe today's 1.3 times book is yesterday's 1.2. And so I want to make sure that if that is the case, that I know it and I can take advantage. So that's my big reason to do it like this. And, you know, maybe it adds some error. Maybe my sum of the parts isn't really right in the first place. So perhaps I'm not getting anything, but I think it's a good exercise to do at least.
sure, absolutely. Is it fair to say though, and like, so this is my like, sky high like view of Berkshire. Is it fair to say the insurance, like Geico and the other insurance aspects of it, is it fair to say, is it fair to think of the insurance units as kind of like the backbone of the company?
Yeah, I think that's right.
Can you explain, like, maybe walk us through just real quick, like how Buffett uses the insurance to kind of like fund everything else?
Yeah, it's funny you asked that. This is probably where I view things most differently than everybody else.
Okay,
So with that caveat,
sure.
the general model that pretty much any investor has of Berkshire Hathaway is the following. They own a lot of very large insurance businesses, and insurance is a negative working capital business. So your customers pay you up front, and then you pay them all that money or most of it back in claims costs over time, but there's a gap. So um, they call that float in insurance. And so Berkshire as a whole, the float today, as of Q3 2020, is about $135 billion. So Berkshire can make use of that float to invest. And most people will say, well, Buffett takes all that money and uses it to buy stocks and other businesses. And it's effectively, since it's just negative working capital, and as the insurance companies grow, it's company that isn't really going to get paid back. So it's perpetual capital to Berkshire. It's very cheap. It costs, as long as they underwrite a profit, it costs nothing or less. And so, hey, he can go out and buy utilities businesses or a railroad or whatever it is. And, he can earn 10 or 12% on that money, and the money he's using costs nothing. That's the traditional view. I don't think that's quite right. Just looking through the financials. And the reason is because in the last 20 years, which is when you can actually kind of look at the balance sheets, he has generally kept sort of fixed maturity securities, which would be cash, government bonds, corporate bonds, and sometimes some preferred stock, at least equal to the value of the float. So today the float's 135 billion, and the cash, he has some preferred in Occidental Petroleum, and the fixed income is 153 billion. So what does that mean? To my eye, he's always been very, very conservative. And regulatorily, he'd be allowed to deploy some of that money that's for the float into these productive investments. But over the last, again, 20 years, he's generally kept fixed income at least equal to the value of that float. So it's not like, he's mostly just investing the shareholders' equity, keeping the float a little safer. You can argue, well, around the financial crisis, if you count some of his preferred investments as equity, then that was using a little bit of the float. I think it's terribly complex. I don't think there's one right answer. I think back in maybe the 70s and 80s and 90s, he probably used a little more of the float for equity investments. These days, I think he's just more conservative, and I haven't seen him use it like people usually say. But what he will do is, take the profits from his insurance business and invest them, in stock, Apple or stocks or businesses or what have you. So,
is holding all that cash smart? Like, what if you were put in charge of Berkshire tomorrow? Would you hold that cash back, or would you how would you spend that cash?
Well, one, I trust Buffett to do the right thing.
Sure. I mean, he had a pretty decent track record, I guess we'll say.
Yeah, no, I think what I will say is I think Berkshire's gone through a few periods. Early days up until the late 90s, roughly when they bought General Re, he was buying common stocks predominantly. That's where Berkshire made most of its money. They bought some wholly owned businesses, but not a lot. And of course, that's where he made most of the excess return of his career. So he made really terrific returns in things like Geico, in Washington Post, Capital Cities, Coca-Cola. Those are sort of the big traditional investments that many people who have studied Buffett remember and kind of understand as being incredible. In the late 90s, Chris Bloomstrand, who writes really terrific letters, Semper Augustus, you can find them, and I would encourage everybody to read them, sort of makes a point that he bought General Re in the late 90s. He had a lot of excess cash due to that, and it sort of changed Berkshire's balance sheet from being sort of over levered to stocks to under levered. And so at that time in the late 90s, there were some operating businesses, some boring ones that weren't tech related that were sort of cheap. And so he started to buy some operating businesses from the late 90s up until maybe 3 or 4 years ago. A much higher proportion of Berkshire's cash went to buying companies whole. And so, they've made some decent stock investments here and there, but mostly they've bought companies. They've done a lot in the utility space. They bought Burlington Northern Santa Fe, Precision Castparts, Kraft and Heinz. And then I guess that's still public, but, they bought Heinz whole or took it private. So I think if you look at the rate of return that Berkshire Hathaway has earned on these bigger wholly owned businesses, for one, they're not nearly as good as the returns were on the stocks in the early days. That's to be expected as Berkshire's size grew and the opportunity set went down. Probably after Burlington Northern Santa Fe, Precision Castparts hasn't worked out very well. Kraft and Heinz haven't worked out very well. It's really hard to buy very large businesses these days for somebody like Berkshire because there's lots of competition. Private equity can pay a lot because they use debt that's quite cheap. Strategic buyers should be able to pay more than Berkshire because they'll have synergies where Berkshire doesn't. So I think, and when you add on the fact that, Berkshire needs to deploy capital at, $10 billion or $20 billion for it to matter at all, that's a very challenging environment for Buffett to make good returns. So we've started to see last year and this year as well, an increase in share buybacks, which I personally fully support. I think he has an advantage in that he has a big conglomerate, and I think it trades at a sort of typical conglomerate discount. It's not huge, but there's a discount there. And so, if you say his options for capital deployment are stocks, well, there's only a few stocks he can buy. Full businesses, there's not that many full businesses he can buy, and he'd have to pay high prices. Or share buybacks. I think share buybacks look really attractive. Berkshire, it's a big collection of attractive assets, and it trades for less than they're worth. And so I think he can put out hopefully 10 or 15 or $20 billion a year at really good rates of return. And he doesn't face the same business risk that he would have when he bought Precision Castparts. If the aerospace market turns down or they have some competitive difficulties, your rate of return might not be very good. With Berkshire, it's so diversified that, maybe one business doesn't do as well, maybe another business does. And when you're buying that whole big group, you're going to get a more average result, but it should be pretty good on average. So that's what I hope for. And I think many shareholders agree. And, I fully trust that at Berkshire, they'll do the right thing on that, if that makes sense.
So given how large they are they too big for their own good? Is it maybe not share buybacks? Well, also share buybacks, but also should they start maybe spinning things off? Or, are they just almost so big and unwieldy now that it's just hard for Wall Street to value? And are they always going to have this conglomerate discount, so to speak? They can only buy so many stocks, like you said, because it has to be a large liquid stock like Apple, where look, Buffett made a killing on Apple the last few years. He bought it at a great time, but there's only going to be so many opportunities like that in a large cap stock that's so widely followed, yet was so undervalued at a certain point. Should they spin things off? Are they too big for their own good?
It depends on what you're trying to solve for, in my opinion.
Okay.
if they broke up Berkshire, I'm pretty much certain that the value of all the companies would be a decent bit higher than what Berkshire stock trades for today. And it's a group of high quality companies. They could do that, and yeah, if you were trying to unlock the value, as they say, then that would work. I think there's a couple ways in which all those companies being a part of Berkshire are good and important. One, on the insurance side, they write some really interesting reinsurance policies. They're basically the insurers for other insurers, and having a silly amount of extra capital is very beneficial for that. Obviously, if me and you go into a contract and I say, hey, if something crazy happens to me, I need you to pay me $1 million in 20 years. It matters if your net worth is $1 million or $1 billion.
Sure, of course.
So that's a big benefit on the reinsurance side. Also, given how much capital they've built up in their insurance business, truly, really excess capital, they can be more aggressive with how they invest. Many insurance companies. So an insurance company might have assets of, let's say, $3, and the float that we discussed might be $2, and shareholders' equity might be $1. That would be a common-ish structure for an insurance company. And so, like I said, Berkshire, they invest their float, the $2 in that, roughly in government bonds or fixed income or cash. And they invest about the dollar in productive things like stocks and businesses. Many insurance companies, given that they don't hold as much excess capital as Berkshire does, they might only invest 20% of their shareholders' equity in productive assets. So out of their $3 capital stack, it might be 20 cents in productive assets and $2.80 in bonds. So Berkshire's, they're able to invest more of their capital, their shareholders' equity, in stocks, which should earn a higher return over time. So I think that's a big benefit and benefits to Berkshire's scale. There's some benefits. Many of Berkshire's operational businesses are quite underlevered, almost no debt, and frankly very few liabilities even. So if they spun those companies off, there'd be shareholder pressure to have a more efficient capital structure. So if what you're looking for as an investor is I want to make sure I make a good return with as little risk as possible, that can happen in Berkshire. If they split off the businesses, I don't think that could happen. And then lastly, maybe the people that run the businesses don't face outside pressures for the next quarter or the next 6 months, which I think is also a positive, and probably I would say more important than many people think. So those are all benefits to Berkshire staying together. An added benefit, if you're a long-term shareholder, listen, if Berkshire Hathaway is worth $500 billion and it trades, or 550, and it trades at $450 billion on the market, and Berkshire has a lot of excess capital and can buy out some partners for less than the stake's worth, then that's very good for you. It's a very low risk way to deploy lots of capital at a good rate of return, and it will increase your return as a shareholder over time. So, you won't get the initial valuation pop, but your rate of intrinsic value growth over time should be higher. So, if you're in it for the long haul, I think you want it together for all those reasons. There's some downsides. Maybe you could say that, not all the subsidiaries are the best run in their industries, and maybe having some public company pressure could be positive for that. But it's a hard needle to thread, and it's hard to say. You know, who knows? You know, if Geico was public, it might be run a little bit better. It's hard to say, but that's a possibility, and I don't think, you know, we should dismiss it out of hand. But I think on aggregate, again, if you're a long-term shareholder, the weight of Berkshire staying together is clearly a positive.
Let's talk about, like, I guess maybe a common criticism of Buffett is that he's missed the boat on a lot of the tech boom, right? I think there's a quote, I'm going to paraphrase it, but I think it's taken a little out of context, a little too much, where he said he didn't get technology back in like 2000. You know, besides Apple, I mean, his other big investment in a tech company was IBM, which did not work out well. Has the world passed Buffett by? Like, is this like has Berkshire missed the boat on tech?
Yeah. I think there's a few ways to attack that question. First off, I think when he says he doesn't understand technology, my guess, and it's not even really a guess, I pretty much guarantee you that if you look at the big tech companies, that Buffett understands the economics better than pretty much anybody else. I think when he says he doesn't understand them, I think part of that is his perception, whatever, maybe I shouldn't speak for him, but I think his perception might be, hey, some of these aren't quite as predictable as people think.
Or maybe like I always took it to mean like the durability of the boat, maybe.
Right, exactly.
Like he would question, like, well, yeah, I get, I don't know, take your pick, Alphabet now or Facebook now, but like, he didn't, and I mean, I think it's a fair point, that he didn't understand, like, how long could it stay dominant in that field, maybe.
Yes. And so, you know, what's funny is that in 20, I think it was 11 was when he bought IBM. And sure enough, you know, if there were 5 or 6 big tech companies, and IBM was one of them, that was the one that didn't wildly succeed.
Right.
You know, the other ones were predictable. That one kind of wasn't. So,
Right.
so, you know, is he the best tech investor out there? No. He's probably made more money on Apple and tech than pretty much any
Right.
other investor I can think of besides a couple. But like, you know, he started off with a lot, so it's cheating a little bit.
Sure, of course.
But yeah, you know, I think, I think they're not as predictable as some of the other businesses he looks at. You know, I've been thinking about this. One thing that's interesting is he's talked about Google and said, well, it's hard to see anybody displacing them. And that was a few years ago, and it's been inexpensive from time to time since, in my opinion. And I own Google. And so, you know, that's one that, you know, he said, well, I understand it. He's on the record as saying he thinks it's predictable. Sometimes what he says on the record might be a little different than what he thinks. And it has gotten to a spot where it seems like you could get good IRRs on it. They haven't bought it. So, you know, I don't know. I think from what I've seen, the investments I've seen him make, and maybe more importantly, investments I've seen him not make, I think one thing that I've noticed is he has tended to buy things sort of at fairly low kind of price to free cash flow ratios. So cheap on that metric, which in the last, 10 years has led to some underperformance. It's not clear to me that, that's always going to be the case. That said, you would have rather bought, take your pick, Google at a
Google,
4% free cash
Microsoft
flow yield
over
6 years ago than,
sure.
yeah, a bank.
Yeah.
So go ahead.
No, I just, it almost, I hate throwing criticism at Buffett because he is in every single way imaginable a better investor than me and a better track record than I will ever have. So it almost feels silly, but at the same time, like, and it almost feels like he's like, for instance, when he bought Kraft, a large investment in Kraft Heinz, like that was like in, for lack of a better term, in an old school moat, right? Like it's consumer brands where that moat was eroding, whereas at the same time, like it seems like he didn't understand the economic moat that Alphabet or Facebook sported around that same time. Um, it, and look, I mean, he's old, and he grew up in a different time, and I just wonder if or I just think like that kind of has hurt him in the last decade, as I don't know, I guess Berkshire's underperformed the market, I don't know, but maybe the last 5 years, I think, give or take. And I think those kind of investments have hurt him because he's still looking for, oh, well, this bank, Wells Fargo, even IBM, it was a cheap tech stock. Wells Fargo was a cheap bank. Kraft Heinz, it looked, it had that old consumer goods like moat, with brand recognition and things like that. Where at the same time, like, like the world was being taken over, software was eating the world, at that time. Like, how much, I mean, do you think that's fair?
Yeah, I'm reticent to say, well, listen, he hasn't had the best 5 years in the world. So, that's this big, terrible crime.
Right.
I don't think it's, first of all, it's not unacceptable for him to make a few mistakes. Could he have made some decisions better? Sure. Could I have made some decisions much better in the last 5 years too? Yes. And, and to a greater extent as well. I think the structure of Berkshire, the idea of it is for him to put out money. His time horizon is a lot longer than maybe mine or most investors is. And I personally think I have a long time horizon. If you're going to buy a whole business, you got to own it for 50 years. And, did Kraft Heinz work out? Like, not really, but, that's okay. We'll make mistakes. But I think what he's trying to do is just stockpile assets that are going to be worth a lot more than they are, over 40 or 50 years. And, if in a 5 or 10 year period, those things don't work out the best, I think that's fine. I think if you
That's a
look
fair
at,
point. Fair point.
yeah, I think if you look at the intrinsic value of Berkshire Hathaway in 2005 or 2006, so whatever year you want to pick, call it mid-cycle in the mid 2000s, and what it is today, in my opinion, the rate of intrinsic value growth of Berkshire Hathaway is greater than the rate of intrinsic value growth of the stock market. Most people will compare, well, how did Berkshire stock do compared to the S&P? You have two large confounding variables in there, which is one, Berkshire went from trading at a premium to the sum of the parts to a discount. And, I don't think that's Buffett's fault. The valuation of the market went up in that time period. It got more expensive. So you have valuation, if you're comparing Berkshire stock return to the S&P, you have Berkshire's valuation working against it and the S&P's valuation helping. If we're talking about Berkshire of the 80s, that wouldn't have mattered because they were creating so much value. Berkshire Hathaway from the early 2000s to now to the future is not likely going to be smashing the performance of the S&P 500 such that, if there's a headwind of 3 or 4 percentage points a year on valuation, that you're still going to beat the market. So I think if you look at that, and that's what you should judge him on, well, listen, he created 10 or 11% of value a year for 15 years with effectively no risk. You know, he was matched on the one place he had some liabilities and insurance. He pretty much just matched them to T-bills, used no debt, and you know, the intrinsic value of the company went up more than that at the stock market. I think that's a pretty good achievement. I think if you look at the assets he owns, I think we have to be a little careful, because there could be a world in which case the assets that he owns might do quite well in comparison to the assets that have done well over the last 5 or 10 years. So, you know, if real interest rates were much higher and nominal rates as well, you know, some of the growth names could have some problems. And something like an insurance company where you have, you know, $150 billion of short-term fixed income securities are going to be making a lot more money than they are, and some bank holdings are going to be doing well. So, you know, the time horizon's long. Were there things that he could have gotten that probably would have made sense? Yeah, but I think that's true for everyone.
Of course.
Yeah.
Right.
So
Yeah.
I think he's done. I think he's done, and you know, some people have an argument against this, but I would say from 2005 to 2020, he did pretty damn good. So, you know.
All right. No, fair enough. Fair enough. What does the future look like for Berkshire after Buffett? You know, like last year, I think it was last year, they made some headlines because they made some unusual investments, like you know, minuscule on the scale of the entire Berkshire, but like still large in dollar amounts. They made an investment in StoneCo, an investment in Snowflake. Like, what does the future look like for Berkshire after Buffett's gone?
It's a good question. I wish I knew the answer. They've Todd Weschler and Todd Combs have definitely made some investments that Buffett and Munger would not make. So, you know, to our point, maybe they will, maybe they'll get some things that Buffett and Munger would have missed, and so that could be a positive. You know, maybe, you know, I don't know. I don't know much about many SaaS names.
Sure.
I'm not an expert there. I've seen a couple investments. Maybe those will turn out great. Maybe they won't. But you know, it's hard to say. I think the only thing you can say is things will be a little different. I hope that, you know, I hope if the stock continues to trade a discount, that the new managers will be aggressive at buying it in. That's my one big hope. I'm hoping that Buffett doing that this year, they bought back a good amount of stock, sort of gives new management license to do that, if that makes sense. But besides that, yeah, I mean, you know, listen, they owned 2 stocks. I own, I don't exactly always know which one of the Todds, Weschler and Combs did what, but, you know, I know I was just talking to a friend and he mentioned one of them, had owned Visa for a while. And I think Visa's one that Berkshire could have probably made a lot of money on. It's been cheap enough from time to time. You know, he owns a lot of Amex. He knows the space, of course.
Yeah, actually, like, I think I've said this on Twitter before. I think missing on MasterCard and Visa. I mean, I think he had small stakes in them, but I almost think that's we can talk about how he missed the tech companies and everything like that. But I think missing on MasterCard and Visa because they were in the space like he was familiar with might be like his biggest mistake. And again, like I feel like too much of the show we're throwing shade at, or I'm throwing shade at Buffett. So I'm not trying to. I do think he's an amazing investor, but I think like you know, if you were trying to pick apart his career, like missing on MasterCard and Visa 10 years ago when they first went public, or almost any time since, really, like because they're in that space that he's familiar with, like might have been like maybe like a worse crime of omission than missing on like the big tech companies.
Yeah, you know, it's hard to say. I was actually, man, I was talking to somebody today, and he was talking about this, and I think Munger was worried about, I don't know, I don't remember exactly what it was, but some competition and maybe some regulation, and they were pretty cheap. I want to say it was in 2011 or 12. I think they traded at a very undemanding price to free cash flow multiple. Certainly how things have turned out for them to not have put a lot of money in those. Yeah, they knew the space. Things could have been different, but on an expected value bet, they were probably quite good ideas. So yeah, I mean, that could have gone better, but what? So those small positions it was one of Weschler Combs. Who knows if they were in charge of Berkshire 10 years ago, maybe they would have put $20 billion into Visa. You don't really know. Like I own Charter, and I really like that business, and one of the two of them or both owns Charter. So they've also done some weird things like GM, which who knows if that really makes sense. But point being, the new people that run it, they'll be different. Maybe they'll own a little more SaaS, but maybe they would also put a lot of money in Visa. It's hard to say. So
what as a shareholder, what will you be looking for, like as either like a real positive sign? Well, I mean, you mentioned buybacks, but like what would you I guess like consider a red flag after the Todds at post Buffett, post Munger, Berkshire? Like what are red flags you would be looking for from the new management team that you'd be like maybe make you a little hesitant about continuing owning shares?
yeah, that's a great question. I think what can be really difficult. So one of the ideas with Berkshire is how do you lose? How do you lose in an entity with, again, their liabilities are matched to T-bills. There's pretty much no debt. They've got this big, diverse collection of businesses that are, mostly pretty good. And they trade at a price where if all the cash was distributed, you probably make 10% returns or more. Given where the market is, that to me looks pretty attractive. The best way that I can think of that you lose as well, when they're deploying new capital, they deploy it at not so good rates of return. What's interesting is a lot of the businesses that Berkshire owns, like the utilities sort of specifically, and some of their assorted other manufacturing businesses, manufacturing services and retailing. A lot of those businesses invest a lot back into the business. And so you'll see the capital expenditures run above depreciation expense by a good amount most every year. So some of the value in Berkshire is just reinvested into the business, and there's not as much true free cash flow as you might think because they're investing for growth. So it turns out, if you say, well, the businesses would make 10% if you paid out all the money. Well, what if they start deploying money at 8? Well, if they deploy all their free cash flow at 8% for 10 years, it's like instead of making 10, you make 9. So you're only going to start to really get in trouble if they start deploying capital at 0 or 2 or 4, some pretty low rate of return.
Sure.
And I think like, I think you give the new people some slack, if they make an investment, in the first 6 months that you're like, looks a little iffy. I don't know how I feel about it. I don't think I'm selling shares then. If over a few years they do a few things that, they don't seem to have the long-term in mind, or they make some just completely obvious blunders, then I'm going to be worried. I think the culture of the place is too long-term oriented and too rational to let one or two people that are in charge of, say, stocks from really running wild with the
Right.
place.
No, I think
Could be
that's right.
wrong, but I would. That's hard for me to see. So, but that's what I would need to see is just real obvious misallocation of capital. Or I get, a good one could be, let's say instead of Berkshire trading at 80 or 90% of what it's worth, let's say for some reason it trades at 60. In that case, you should be spending every dollar you have on buying back stock. And let's say they just go out and buy, some sort of expensive company that could be okay, but like, your 10 or 20-year rate of return probably isn't going to be that attractive, then I could have a problem with that. That one can be a little more concrete.
Sure. If the stock was trading at 110 or 120% of fair value, and so buying back stocks was not attractive, what would you want to see? Would you want to see a dividend? Would you want to see like how would you want capital to be deployed in a scenario like that?
Yes. That this is okay. Another disclaimer. This is another place where I feel a little bit differently than most investors.
All right.
So Travelers is a really interesting company. They operate
The insurance company. Yep.
Yeah, sorry, they're a big.
Yep. No, great insurance company. Yep.
Yeah, so they've operated almost financially almost the opposite of Berkshire Hathaway. So when I was talking about an insurance company with $3 of assets and say 20 cents of the 3 in investments being in productive assets and the rest bonds, that pretty much describes Travelers. They have just a big portfolio of high quality bonds. They've got a good insurance operation that underwrites profitably, most every year. It grows a little bit, nothing crazy. But financially, they take any excess capital they have and they buy back stock, and they don't really worry about what the price is. And it hasn't often been at a price that's silly high, but sometimes seems a little expensive. But the idea is, okay, listen, one, we don't exactly know when our stock's a little expensive or a little cheap. But if we buy back our stock that's 10% too expensive, that might be better than keeping the money, in short-term bonds to earn 1% and to try to wait 4 years until our stock gets a little bit cheap. It's like if the IRR on our buyback is 7 or 8 instead of 10 or 11, that's going to be better than holding cash and trying to deploy it later, perhaps. So they've just said, hey, we're going to get rid of our excess capital. Turns out, if you look at the intrinsic value of that, and I haven't checked on this in the last maybe 6 or 8 months, but I believe the stock price as well, you can make an argument the intrinsic value has grown faster than at Berkshire, and I believe their stocks outperformed. So
right.
It's an interesting financial philosophy, which is just make sure your capital structure is, I don't always like to use this word, but efficient.
Right.
And they've done pretty well for themselves. So, let's say Berkshire is at 110% of their intrinsic value. Let's say I'm not going to sell it for some reason, the whole position, maybe it's taxes. Let's say their choices are keep capital on the balance sheet, pay a dividend, buy back stock. With Berkshire, I don't mind so much, especially compared to other companies, if they keep a little excess capital from time to time. I think it's good. I think it makes the company safe. It obviously gives them great opportunities if the markets melt down. So I'm relatively more okay than other places with them keeping a little bit of extra cash around. I think that's generally good. If they get way too much cash, if they pay me a dividend, I mostly run money for people that live in California and pay taxes. So, even the taxes on dividends can get kind of high. Even again, so this is where I'm going to say something that people won't all agree with. Even if the stock's a little expensive, I would prefer a buyback. And if it's expensive to me, then I can sell proportionate into the buyback and I'll pay less tax than I paid on a dividend. If I think it's at fair value, maybe I won't sell it at the buyback, but it, it just gives me the option to do whatever I want with it.
Sure, sure.
So, you know, whatever. That's not finance 101. People tell you, well, if your stock's too expensive, don't buy it back. And I'll say, you know what? I'm a shareholder. I can make that choice myself.
So I actually agree with that. Like, if I had to pick one investor, who I've learned, or who I try to like model myself after in some ways, it's Pat Dorsey, right? It's not Warren Buffett. And he's very big on, though, like on making buybacks when it's like undervalued and like deploying that capital wisely. But I've always felt like you can make a case for any company. Like we tell investors, like, you can dollar cost average into stocks, like, when you're unsure about the valuation, but you think it's a great company. I think you can make the same case for companies to buy back their stocks. Just like, you take any company that regularly buys back stocks, and I think you can make a good case. Like, well, just, if you regularly buy back stocks, like, yes, sometimes you might be buying it back when it's a little overvalued or a little undervalued, but like I still think that can be a wise decision to allocate capital.
Yeah. And I really think that that Travelers example, I think that's an example that all investors should study deeply, in contrast to Berkshire Hathaway. You can come to your own conclusions. You can say that, well, the risk profile is different. Under some circumstances, things would be different. But it is interesting to me that a company that allocated its capital very differently than Berkshire did a little better in a similar industry. And it's not like insurance shot the lights out over the last 15 years either.
Right.
So I think that's important to keep in mind. I owned, for a long time, I owned AutoZone, and AutoZone,
Bought back a lot of shares.
yeah, they buy back a lot of shares. And in the last 5 years, that's actually one of the more interesting business cases I'm aware of. Is, I don't know if this is still true, but as of a few years ago, since the late 90s, I believe the amount of transactions done in an AutoZone store had been kind of flattish over those 17 years. And the stock is up, I don't know if it was 50x or 100x, but some huge amount. And what's interesting, the reason is because the price of the parts went up a little bit, their margins went up a little bit. They bought back stock, they built a lot of new shares and took market share. They used a little bit of leverage. It's like every other piece worked in the same direction, and you made a tremendous amount of money. But in the past few years, that business, the margin expansion has slowed or stopped. They're going to run out of new stores at some point. You could have paid a high multiple 20 years ago. That's not been the case recently. And so, I don't own it anymore, but there were a few times when, AutoZone traded what I thought were a little too high. They bought back some stock, and I sold proportionately into the buyback, and that was fine. I paid less tax than I would have if it was a dividend. So just as long as I think a company has a consistent financial policy, like you don't want a company that runs at zero net leverage to say, hey, we're going to lever up 4x to buy back a huge portion of our stock when it's overvalued. If they're doing it in a sort of normal way with normal leverage targets, then you know what, buy back the stock. I'll sell it if it's cheap. That's what I prefer.
Sure. Last question. Is there a next Berkshire on the horizon? Like, so sometimes people talk about Markel or Boston Omaha. I almost think you can make a case for like a Constellation Software or Roper, where they like roll up companies like in kind of similar businesses and try to realize synergies. Is there a company out there that you think could be like the next, is today like a quote unquote mini Berkshire that could grow into become the next Berkshire?
There are some acquisitive industrial, business to business companies that have quite good track records. You mentioned a couple of them. Constellation Software's, to my eye, probably the best, and I own that as well. I was, again, just talking to somebody about this, and I think Constellation Software's odds to match Berkshire's intrinsic value growth over, 30 or 40, 50 years are maybe better than anybody else's. So yeah, there's some companies that have that acquisitive gene and are very good at it and have some big advantages. I think the sort of Berkshire-likes, the mini Berkshires in insurance have generally been a disappointment. You mentioned Markel. I think that's been the best managed company in that space.
Sure.
You have a few others that the pitch was, well, this is mini Berkshire Hathaway. They didn't work out well at all in some cases. I think it's really hard. I think Buffett doesn't get enough credit for how good of an insurance executive he is. If you look at how, before Berkshire became as big as it is now, with all these non-insurance businesses and all this extra capital, if you look at a normal insurance business that's well run, you can compound the intrinsic value much faster than the return on your equity portfolio. And the way you do it is, let's go back to that example. You have $3 in assets, $2 in float, $1 in shareholders equity. So just say, you invest the $1 in shareholders equity in stocks and you earn 12% a year. You're a really good stock picker. And so, if nothing else happens, your book value goes up 12% a year. Well, the second piece is you have $2 of bonds and they're going to earn some interest. And so let's say, that could add, depending on where interest rates are, that's going to add some income. And so the first year, your book value is not going to go up 12% a year. It's going to go up a little more than that. And then lastly, if you underwrite at a profit, that's going to increase your earnings and your gain in book value as well. What happens is, let's take that insurance company, the first year, if your stocks make 12, your intrinsic value and your book value might go up 17% when you add in the income from the bonds and the underwriting. If you underwrite $1 of insurance business, and the next year you still underwrite $1 of insurance business, the income from the bonds is going to be pretty much the same. Say the income from the underwriting is going to be pretty much the same, but you're going to have a bigger base of shareholders equity. So those two little boosts to your growth are going to matter less. So as the insurance business gets bigger, if it's just now more of your returns can come from stocks and your gain in intrinsic value is going to be closer to 12 than your hypothetical 17. So what you really need to turbocharge growth and compounding is you need the underwriting to grow sort of along with your book value, because that keeps your leverage of the bond income and the underwriting income high and can boost your returns. And so if you look back at Berkshire, what he did incredibly well was grow and grow and grow that insurance business so that he didn't just end up with all this extra capital. He kept increasing the amount of the float, which, he could invest and earn income on, and his underwriting income, so that it was like, if he maybe earned 13% on his stocks, but he got another large boost to his return on equity because the insurance business grew along with it. And that is something that few insurance companies have been able to do. And the ones that have been able to do it haven't pursued a Berkshire model. They're sort of more of a payout model. So you need both of those things. You need really good investing, and you need that sort of incredible performance from your insurance business. And I haven't seen those two things married since Berkshire. Many people have tried, but it's difficult. So
sure. No, absolutely. It's a pretty impressive track record that has not been matched too often, if ever.
Yeah.
Kyler, where can people find you if they're interested in following you?
Yes. Best places on Twitter at Kyler Hasson, Tyler with a K, last name's Hasson. I'm on it a lot, maybe a little too much.
I can relate.
I respond to direct messages there. I'm on the company I work for is Delta Investment Management. You can find us online there if you prefer and reach out. Those would be the two best places.
All right, great. Kyler, thank you so much for joining us. Again, I'm
Thanks.
Matthew Cochran. We're 7 Investing, and we're here to empower you to invest in your future. Have a great day, everyone.
Thanks for having me on.
No, thanks, Kyler. Appreciate it, man.
Yeah, that was great. Thank you. Yeah, hopefully that's useful for people.